The U.S. stock market is entering a cautious but potentially constructive phase. After months of gains driven by large technology and AI-related stocks, investors are now focusing on interest rate expectations, corporate earnings, and signs of economic slowdown. Positive factors include growing expectations that the Federal Reserve will start easing policy soon. Inflation has moderated, and the labor market shows gradual cooling, giving the Fed room to signal rate cuts within the next few months. Lower interest rates would reduce financing costs and generally support growth stocks, particularly in technology and communication sectors. The U.S. economy remains resilient. While growth has slowed, consumer spending and corporate profits have held up better than expected. Ongoing investment in artificial intelligence, infrastructure, and clean energy continues to provide a cushion. In addition, the U.S. dollar has weakened slightly, which could attract more global capital into equities. However, risks remain significant. Market valuations are high, especially among the Magnificent Seven tech giants, and recent gains have been heavily concentrated. If those leaders correct, the broader indexes could quickly pull back. Long-term Treasury yields also remain elevated, reflecting fiscal deficit concerns and sustained government borrowing. High yields limit valuation expansion and keep competition between bonds and stocks intense. External factors such as trade tensions, geopolitical risks, and U.S. regional bank vulnerabilities still threaten to unsettle markets. Historically, this period of the year tends to bring higher volatility, and sentiment could shift rapidly if any shock emerges. Technically, the S&P 500 remains near key support levels, with buying interest still present but momentum weakening. Many institutional investors have increased cash positions, suggesting they are waiting for clearer signals from the Fed and upcoming earnings reports. Possible scenarios: mild rise or sideways trend, is almost equal to 50% probability markets stabilize, supported by optimism over policy easing. Minor correction is almost equal to 40% profit-taking and valuation pressures lead to a 2 to 5% pullback. Sharp drop is almost equal to 10% triggered by an unexpected economic or financial shock. In the next few weeks, investors should closely watch the Fed's next meeting, inflation and employment data, and corporate earnings from major tech and financial firms. A combination of soft inflation and steady earnings could keep markets stable. Overall, the most likely outcome is a volatile but range-bound market with a slightly positive bias. The key challenge will be maintaining discipline amid uncertainty. Diversification, selective exposure to quality companies, and prudent risk management remain essential. Rather than chasing short-term rallies, investors may benefit from patience as the market tests whether optimism about rate cuts can outweigh concerns about growth and valuation.